Hello, and welcome to this webinar on capital in 2023, the economy's impact on your business. My name's Audrey Ngoe, and I'm part of the growth advisory team here at Capchase. So helping early stage companies identify which areas of their business to invest in and when. So for those of you that don't know, Capchase is a platform that helps SaaS founders and CFOs grow their business through non-dilutive financing and market insights. So I'm excited to be hosting this very timely discussion today on how startups can adapt their capital planning to the challenging times of 2023 and still keep growth on track. So joining me today are my esteemed colleagues, Jonah Rems and Ayas Bamner. So Jonah is our VP of Finance here at Capchase, and before joining us, he held a number of finance director roles, including at the payment startup Bread, where he led FP&A and strategic finance. And prior to that, he worked as an investment banker for Houlihan Lokey. Ayas is our head of capital markets here at Capchase, and he has a background working in finance for early stage businesses, having previously held roles at Deutsche Bank, Alma Stone, and Route 66 Ventures. Both Jonah and Ayas have been extremely influential in helping Capchase close funding rounds, totaling over 900 million over the last 2.5 years. And they bring with them today that expertise and not only raising capital in difficult markets, but also investing that capital into growth for the business. So welcome, Jonah and Ayas.
Thank you for the introduction.
Great to be here. Thanks for the intro.
Brilliant. So a couple of webinar logistics to start us off with. So you can ask any questions throughout the webinar, and you can submit these through the chat. We'll look to answer these at the end of the panel discussion, and we'll be breaking the webinar up into two parts today. So diving straight on in, I'm keen to look at the macroeconomic environment and how this has impacted capital markets. So first question for our panel, what are the broader trends that are impacting the capital markets in 2023?
Yeah, Audrey, I can take lead on that one. So I think the biggest trend here that we saw at the end of 2022 and continuing in 2023 is the need for the Fed to carry out their mandate to combat inflation and reduce the size of the Fed's balance sheet. So I think what we're seeing is what's called the open market operations, where the Fed has been trying to increase interest rates, which is the cost of borrowing, to combat inflation, bring that down. They target typically 1% to 2% year-on-year growth, and they're currently, in the middle of the 8%, 6.5% progress there. On the other side, they're also selling bonds, or quantitative tightening, which is the opposite of the quantitative easing we saw on the back of the great financial crisis. This is designed to decrease the size of the balance sheet, which has really inflated. It's now currently, or hit a peak of about 9 trillion, just under 9 trillion. And it's undetermined where they want that to be in terms of a steady state, but it's having an impact. It's effectively taking money supply off the table, and it is increasing the cost of borrowing, which effectively moves capital away from innovation and entrepreneurship and growth and towards safer industry and safer asset classes. So I think what we are seeing is a higher cost of borrowing across the board. We're seeing a reduction of, call it, risk plays into more safer assets with longer track records and just more risk off. And we're seeing just more relative return given the risk for these safer assets, which is something that we hadn't seen before. So I think, in this and how you think about your company and your fundraising motives is effectively knowing that you're going to be charged a bit more. So you really have to make sure that when you raise debt or you go out to the capital markets, that you see a positive ROI on that debt side, and you are taking into account the future, which honestly is a bit uncertain. And we don't know what that really looks like, but signs currently still point to a higher interest rates as long as inflation remains quite high.
Yeah, and to piggyback on that, I think, Ayas was talking about folks that are, looking a bit more of a risk-off lens. And I think overall, just the way that companies are now perceived in this market, where there are, safer assets that really used to have not much that could drive in terms of return, but now they are far more attractive. it is definitely a bit of a more restrictive lens that startups that previously maybe weren't judged as much in terms of that relative runway and whatnot. They are definitely under the microscope a little bit more.
Thank you for that answer. And I think we kind of covered off a little bit of my next question with regards to what should we be expecting for the remainder of 2023?
Yeah, it's interesting, Audrey. About a week ago or so, there are two things, right? There is how the private players in the market think that interest rates will act. And then there is the Fed, who actually is controlling the federal funds target rate. And that is really the driver of how interest rates actually move. And what some of the private market players do is they say, today the interest rate target rate is, let's say, 5%. We think it's going to be 6% in a year, or we think it's going to be 4%. And coming into 2023, I think the market was really starving for good news. And so you see the forward curve, or it's the predictive curve looking forward. We saw market participants say, maybe the Fed will cut rates. Maybe it'll go down a bit. Maybe we'll get into a rate cutting mode because the economy is truly turning around. And then you heard comments from Jerome Powell last week, effectively saying, I wouldn't count on that. Perhaps it won't be as much of greater or as high of interest rate hikes as we saw in 2022, but the economy is still needing to show better performance across the macro industry indicators, such as inflation, the jobs reports, the supply, the money supply in the economy. So I think what we're really looking at is a bit more consistency, which is really positive, right? It's not as volatile and uncertain as last year, but we're not quite in a way where the economy truly has turned the corner and is absolutely on the right and recovering path. I think what's good about that is there are signs that we will get there. We'll get there quickly, but I don't think we're quite there yet. And I think the Fed chairman's comments reflected that.
So hoping for a bit more stability, I'm hearing for the rest of the year.
I think that's fair, and I think, Jonah, I would turn to you on this one, but I have to think that the most annoying thing to project out is volatility, because the definition of that is uncertainty, and you don't know how to make your corporate model or what to expect. I think, different from 2022, we can at least say, well, we expect it to not be as bad as that. And I think we can probably feel that with a good degree of confidence. But to say that it'll get necessarily better from where we are is probably a bit of a stretch.
Yeah, I agree with that. I think even you can start to sense a bit of a tone shift of when we talk to different players in the market around, our own capital needs and the, conversations that might evolve over time. Whereas in, call it, mid-2022, it was really hard to predict, if a company would have the same view in 2 months as they did when you maybe started a conversation and you kind of brought them along that path. Now there seems to be a little bit more of a continuity and folks standing behind a view for a longer period of time, as they believe it's a little bit, that degree of predictability is a bit higher. But like I said, I think there's a lot of work to be done there and to see how things play out. But it seems to be trending in the right direction.
Yeah, just one more point to add on too is that I think it's easy to talk about market players and how they act in uniformity, right, across the board. And it's a good generalization, but I think no matter if it's a lower interest rate environment, a rising interest rate environment, or a high interest rate environment, there's always going to be players that look for opportunities, right? They're going to see some opportunity between the lines there. So when we say that there is some optimism in the market, it doesn't necessarily mean across everybody, and vice versa, right? So I think there's always somebody that will see what you're doing and find opportunity or find a positive in that. So there's always something to be done.
Definitely. So with regards to these trends that we're seeing, how do you expect this to impact kind of interest rates that founders and finance leaders will be seeing for their businesses specifically?
Yeah, look, it's going to be higher, right? Quite bluntly, market rates are going to be higher before they get lower. I do encourage participants here to do a quick Google search on the forward curve of the federal funds rate, right? And I think one really good resource that we're happy to share is it's how the actual Fed governors vote. And that is how market participants really think about the forward curve. And so it is a governor saying that in 12 months, I think it's going to be 6%. And they aggregate these votes, and that's how kind of participants then use their liberties there. But all of those cases show that there is, in the short term, it's a bit higher. In the long term, it might be lower. And obviously, I think as the longer you go out, the more uncertain that future really becomes. But I think there is a common advice for conservatism, right? There is a common advice for extend your runway, decrease your burn, focus on your margins. And I think that holds for a bit.
Thank you. So last kind of question for this section. What are the factors that impact the cost of capital for startups and small businesses in the audience that we need to consider for right now?
Yeah, I think if you look at the Fed's website, they have a mandate to control inflation and control the growth around inflation. So when reports come out that show 6.5%, yes, that is an improvement from 8% growth. And then you can break that down into whether it's real estate or consumer goods or different staples or food. But the reality is that is still far away from a 2% growth in inflation. And that had been the steady case for a very long time. So what we're experiencing now is quite unparalleled, certainly for the last few decades. So I think that is the key thing to focus on. I think what we can break down kind of other macro indicators such as employment and GDP growth in different ways. I think what the administration is doing now is different than what the administration was doing before that. So it's a little bit difficult to determine, is this good? Is it bad? Is it neutral? But I think one thing that we can kind of always look at is how consumers are acting. So one thing that we like looking at is, what is consumer debt doing? What is personal savings rate doing? And that is a very good indicator of where expenditures and how the economy is actually growing in terms of who's making money and how they're spending it. And what we're seeing has been consumer debt has been starting to grow and personal saving rate has been moving in the opposite direction. And I think where we are looking for is a bit flatlining of that, of saying perhaps the velocity or the turnover of spend coming out of the COVID years has started to decrease a little bit. So I think as Jonah mentioned, we still have a little bit of work to go, but I think we are seeing positive trends in the right directional move in those areas.
Thank you so much for covering that off. So now switching gears slightly for the second section of our discussion, I want to turn to the practical ways that founders and finance teams can adapt the current macro environment. So what are the key ways that founders and finance leaders need to adapt their normal capital planning processes to these conditions?
Sure. Yeah, I'll take this one. So first and foremost, everybody needs to start it earlier now. I think often in the past, and the days of through 2021, where it was, as we've all heard, kind of growth at all costs, it would be often a kind of grow, and then once you've proven this exciting kind of growth trajectory, then you can kind of think about capital because you get a as beneficial of a valuation there. But now it's really about how can we be as flexible, agile, proactive as possible to really start thinking about that capital planning process early. And for the variety of outcomes, because often you can really think of capital as it's that buffer to make sure that you're never raising with your back against the wall. You're never in a point as a company where you are operating out of desperation, but you've thought ahead of time and you've been able to plan for all the various potential outcomes. So, look, one thing that has been kind of shouted loud and clear across, all industries really, especially in the startup space, is that the days of growth in 2021, growth at all costs, are gone. Now there's the focus towards profitability, managing the burn, unit economics. And this is all true. I think it's also around how can you really highlight of those unit economics pieces, like the direct impact in capital that you can have through things like effective pricing and margin management, as well as just really being able to grow in that accretive manner. So finding that kind of that balance of what is that right way to manage my profitability and my burn, but I can also think about capital as the tools that I'm actually growing in the right way. It's not just a full trade-off of one or the other. And then lastly, on that point of the different potential outcomes, I think being very honest, especially in a startup where we always like to think about here are the best potential outcomes, but being honest and thinking about what are the 2 or 3 different ways that this can play out, and what is the capital that might be needed in those situations, And you always want to plan for that. You always want to be capitalized if things don't work well. But then when they do work well, then you're in a really strong situation.
Brilliant. Thank you so much for that, Jonah. And kind of moving on to the next question, how should the audience approach planning for long-term capital investments in this uncertain environment?
Yeah, so I think kind of building off of what I just mentioned, I think everything takes longer than you think, whether that's debt, equity, executing on a plan. And so as you think about the longer term capital investments, whatever you think that potential time frame of when you might need it is, the approach that I've always thought of and that we've taken at Capchase is approaching the market quite a bit earlier than that, so that you are well equipped for the different potential outcomes. I think there's also understanding what is your after operational actions that you might take to reduce burn and whatnot, what is an appropriate buffer of cash at all times that you want as a business. And your long-term capital investments should always really keep that in mind, so that there's always that buffer, so that you never are in that place where there's kind of approaching capital from a point of desperation, because the market will react accordingly. And whether it's by means of valuation or just capital availability, those things will be a lot more challenging. I think in general, it's always really helpful when doing long-term capital planning. It's a good forcing mechanism in terms of kind of rallying different stakeholders across the business to understand what are the true best potential outcomes of the business, what is the investments needed there to dive in and see what is the actual deep need of those, and where can you push, where can you stretch, and that can really give you that range of capital that you then think is appropriate to make sure that you have enough time to go acquire it.
Yeah, and I think also from the perspective, right, just to add on to that, right, if you go out to the market, call it 2 years ago, right, you could have a really good idea, and perhaps you'd be rewarded with equity capital, or you'd be rewarded with debt capital, and investors had more appetite for that. Well, as it's tightening, right, what are they looking for? They're looking for more unit economics. They also want to invest in companies that look more mature, are more mature. So I think it's more important also than ever to invest in some of the back office processes, right? Invest in having the right accounting systems, look really buttoned up. When you go to an investor, make sure you have the exact data room they're looking for with all the resources. Really put your best foot forward. And I know that sounds trite, but I think it is actually it's surprising like how much of an impact that can have on your first initial conversations, so that your ideas really shine through and they don't have to worry about how you're accounting for it, how you're managing it. And then Audrey, just one last thing on the long-term capital planning. I think now more than ever, with all the uncertainty in the macro environment, it's really important that someone on your team really understands how to analyze the capital markets, the macro economy, and can obviously do other things within the company with that. But understanding how a view on that may change is going to have an impact on your projected capital or corporate model. Right. So I think understanding what the scenarios are, being able to trigger them, and then working with your team to determine what the best path forward is, it's going to give you all the array of options. And depending on your product, depending on your company, and depending on how you wish to grow your business, then you can make the most informed decision, and that will show in your diligence process.
Yeah, and to kind of build off something Ayof said, going back, when I joined Capchase was January 2021, and the company had been around for about 6 to 12 months. And very quickly, what we saw was that this company is growing very fast, and we need to get a lot more mature and sophisticated in terms of our financial infrastructure. And oftentimes you see startups wait till they're a little bit later in the kind of maturity cycle to, whether it's invest in finance resources or get more serious about accounting. And these aren't always the fun things that you think about when there's growth. And it actually goes contrary to the point that we all hear about of there is importance of reducing spend. And so it might seem contrary to then say, well, invest in finance and infrastructure. Well, back when we joined, we saw that the business was going to get more and more complex. So we moved very early, as an example, over to NetSuite from QuickBooks, which traditionally most startups begin with. And not to say that that's the right move for all startups. It just shows that that was something that we saw as, if we can really make sure that we get our ducks in a row in terms of our financial infrastructure, the market will reward us, because we're able then to really project and with confidence internally manage to a different degree of financial organization and being able to understand the liquidity picture of the business better, be able to manage different stakeholders in terms of expenses. And those things really compound in terms of the value that you have going forward if you invest early on.
Definitely. Thank you so much for the response there. And I think it's good to hear as well that kind of investing in that infrastructure can potentially later down the line be rewarded with the speeding up of any due diligence processes. So thank you so much. And I mean, we kind of touched on this, but looking at kind of building out a healthy capital stack, where would you guys say that debt fits into that, and can it be part of a healthy cap stack?
Yeah, I think, look, absolutely. It's really important. Debt has many different forms, and there's different ways that a company can go after the debt capital markets and a different product that may or may not work for a certain structure. But ultimately, debt can be an incredibly useful tool to add buffer towards that liquidity so that a company can operate on its core goals and do so in a non-dilutive manner so that you don't have to give up less of the business, while getting that additional liquidity. I think it's very important to understand in deep detail what are the terms of the debt, understanding what does that do to the cash flow profile of the business. So whether that's the implied fees that are there, the amortization period, so how fast the debt pays down, what are any situations whereby the debt may suddenly become unavailable because of covenants. But ultimately, once you gain comfort with that, debt is a really integral tool, I believe, in being able to kind of prove out the business and operate on your plan.
Yeah, I mean, Capchase is in the business of providing non-dilutive capital, right? So it is. I think we feel very strongly about the value of that, right? But I think it's important, right? Whether you're at an early stage and you're trying to scale your product and you just need to get it out there, or you're at a later stage and you're scaling for lower cost, right? It's important to understand what you're using the debt for. Runway extension is great. That is one use case. There are other use cases such as making sure you have marketing spend or hiring, right? And sometimes you don't always need to use equity capital for that. That can be very expensive in terms of dilution. Regardless, it's always important to run your short-term and long-term needs. Are you generating a positive ROI, right? Is this marketing campaign going to deliver X% X multiple more of cash flow in the future, and in what time period, right? And that'll kind of determine what the debt you need. And then you look at a term sheet and you see a certain price, you're going to know inherently, is this worth it? Or am I just taking debt to use it and not actually make positive cash flow? So I think regardless of what stage you're in, there is a place for it, but it really depends on your product and your use of proceeds. And I guess I would say, just make sure you're clear on those. Only you know your business, right? So just make sure you're clear on what that ROI is and that the right quantum and the right rate is being applied to you.
Brilliant.
Yeah, I saw the question, Brian, around how often are we hearing about lenders calling debt early and flexing the material adverse clauses. So, candidly, from at least the way we see it in like the markets that we've interacted with from the players, both in our portfolio and the capital markets players, not sure in terms of calling debt early, but that might just be the space that we operate in. In terms of material adverse and overall just structuring, I think there's been a very noted kind of increase in the level of structuring that we're seeing across the board. For whatever use of debt, whether it's term loan, revolver, et cetera. That's why I think, from Capchase and the way that we approach it from a non-dilutive financing, very simple, flexible structure. In times like now, we see a lot of people opting for, that sort of, debt financing versus something where there's this kind of continually increasing complexity around the structure where folks aren't really certain when exactly that, that faucet will be turned off.
Yeah. And on the second question, we saw that clause being triggered during COVID from a number of different players. And I think that was unpopular and a bit of an anomaly, but the best way I can describe it is I would say it was a bit of a loophole that lenders were able to get away with. I can say from our personal experience, we were advised heavily by our legal team to ensure that that could not happen, right? So I think, yes, I believe that happened a couple years ago, but if you're striking debt and you have a good lawyer, they should be giving you the right language to ensure that that can't happen, even with something such as a COVID event, which I don't think was structured into many term sheets, call it pre-2020.
Brilliant. Thank you so much for that that kind of question. So kind of shifting gears a little bit, what's an acceptable level of debt? Like what's an acceptable level of leverage in the current kind of environment?
Yeah, I think there's no right answer depending on the company. Some companies may be more capital intensive than others, and so or might be, have higher degrees of working capital swings that really require that they have more buffer than one might expect. But ultimately, the way that I always like to think about it is it's a comfortable enough amount that you're not flying too close to the sun, in that you have that buffer that allows you to operate with a little bit of flexibility and never feel that you are running up on a close to cash out before you expected, because you have this kind of I don't want to say rainy day fund, but you have that breathing room. Now, there's naturally, you never want to over leverage, because whether it's covenants that you can break, whether it's just the significant cost of the financing that can create challenges on the P&L. These are things that it's finding that right balance, that here is the amount of liquidity that you can use to get that buffer, to extend that runway to a comfortable, whatever it might be, 18, 24 plus months, but doesn't unduly impact your P&L to a point where it becomes unattractive.
Brilliant. So kind of thinking down the same vein, what would you suggest for a business that came into the economic downturn slightly over leveraged?
Yeah, I think it goes back to one of the earlier questions you asked around founders approaching capital planning right now, and my view there is always around the earlier the better, and just getting ahead is always better than surprises for all the players that are involved, right? So whether that's the players being the company, debt investors, equity investors, understanding where if you're over levered and seeing potential issues down the line in terms of debt service, in terms of covenant breakage, running out a lot of different scenarios to understand what could happen, what are potential milestones that trigger events that could lead to concern, so that you have a plan in place if that occurs. Now, a plan won't automatically fix, if your company is significantly underperforming and you're over levered, but what it will give you is a playbook to go approach the relevant lenders or go approach equity investors in a timely manner before things have spiraled out of control. Now, outside of that, I think there's also what can you do around over leverage to really right size the overall business model. And that comes back to a lot of the cost containment, margin appreciation, getting your kind of collections process and overall working capital management really tight. And all of that's really around just making sure to put yourself in the best liquidity situation possible, so that you're never in a position where you are not able to make a debt obligation, even though if you had pushed just a little bit more here, a little bit more there, you could have potentially, you never want to have a hindsight that something could have been solved if only you had planned a little bit ahead of time.
Yeah, and I echo everything, Jonah, you just said. And I think one other thing I'd add, right, is from the transaction point of view, transactionally, right, always search out for creative solutions as well, right? What you have currently may not be the only thing that exists out in the market, right? If you've got a great product, but you are kind of bound by, let's call it a rigid capital partner, you might be able to find a flexible capital partner who sees the value in your platform and is willing to make concessions or to help you get out of that relationship and start a new one that could be more creative. It won't be free, right? There's always a cost to doing that type of business, but the only way that you're going to figure that out is if you call the market or call some experts or just really understand what all your options are. So I would stress that because you're with one partner doesn't mean that the rest of the market's going to act the same way.
Thank you so much for those answers. So now for my final question. If I need to take on more debt this year, how should I think about the cost of capital and ensuring that it's affordable for my business?
Yeah, I mean, I can take a stab at this one, and like I'd say, you want to consider your margins, right? You want to consider everything from the top line, run your full calculation on your business when it's not levered at all. You need to understand your sales, your conversion rates, your LTV CAC ratios, understand your customer profile, and then layer on your expected cost of debt. So, if it's, I think venture debt is trading anywhere between the WSJ prime rate +1 to WSJ prime rate +7, depending on the rest of the package, but determine kind of what that number is that causes you to go break even. Another way of saying, here's my business. It works without leverage. I want to increase the revenue of it. I want to increase my bottom line. What number is my break even? What number causes that number to go red? That's where you work backwards from, right? And so then and Jonah can talk to this at length, but in your financial statements, you put in an interest expense, right? And that interest expense comes right out of your income statement. And if that causes your margins to take a hit, well, then that debt is not really accretive to your business. It's not providing much value. So, my advice to that would be understand your business model, understand that break even, and then stress that, right? What if your cost of debt is 2x that, 3x that, right? Know what the forward-looking numbers for your business are that would make it make sense to take on that debt. And then, you have to make your own choice. You have to make your own subjective decision on what the future will hold, because I don't think any of us have a crystal ball. But you should know by running that exercise when the markets move one way or another, is that good for you? Is that bad for you? How close are you to that break-even point? And I think the only way you can do that is running those scenarios.
Yeah. And I think for, early stage, either venture back or bootstrapped companies that, we typically work with in our portfolio, the equation might be a little bit different even there, where oftentimes if you think about what is the alternative and what are you working towards, it might be whether it's eventually an exit event, or more often there's, equity raises along the way. And how can you get the business to a certain place? It's how can you use that capital that you're injecting into the business to not just look at it from what the margin profile is today, but if you invest that, what are you going to get out of it? So to Ayas's point, if you have a certain LTV CAC and you have a certain gross margin profile, if you invest those funds, what is the increase in conversion rate that you might expect, or just what is the more at bats that you're going to have because you have a profitable channel that you've already looked at. And then when you think about that, gets me to a point of arrival of, even if I'm not going to be cash flow positive, but it gets me to a raise in 9 months from now. And the business looks much more solid because I've been able to use those accretively. Even though a cost of funds was, a certain level, you can look at that against what's your relative cost of equity of raising money and the amount of the company that you would give up. And that can really help play and show how much your business truly can sustain and how much it really puts you in a better position overall for that long-term value of the business, to the extent that you're able to invest those funds accretively. And that's what we really love to see, Capchase in our portfolio, is companies that, have these amazing success stories of identifying a repeatable go-to-market machine. And the constraint is the cash. But if you take cash and really invest it and see that grow, you can then ultimately accelerate towards a much more attractive raise where you would gladly take on a cost of capital that probably was honestly materially even higher than what we or other similar providers are offering.
Brilliant. Thank you so much. Thank you so much, Jonah and Ayas. So let's move to the audience now and see some of the questions that we've had submitted through the chat during the discussion. I can see we have a first question here. I'm thinking of using debt for the first time, but worried that in the current market, there's a lot of predatory lending, especially since we're early stage and don't have much to offer in the way of collateral. What do I need to be looking out for that could be red flags with a lender?
Yeah, I think one of the great things about the last decade and a half, especially the last 5 years, has been the birth of companies that service other business models that traditionally have been underserved, right? There's a different way of looking at it. So I think to answer the first part of your question, always look out for covenants, right? Make sure that negative covenants are really not punitive. If you feel like you don't understand them, I would advise to invest in a good lawyer, right? I think that will always pay dividends in the short term, medium term, and long term. I think that the idea of not having collateral in the traditional sense, and just to define that a bit broader, is collateral. It could be something in traditional, such as your house under a mortgage, or your car under an auto loan. For businesses, it's more your inventory, your hard assets, right? What you have on the hard assets, your balance sheet. Well, what companies like Capchase and other companies that have come up during this time is we're trying to look at how a company generates cash and how strong they are, regardless of the traditional definition of collateral. So I think for the first portion of your question, I would say, watch out for negative covenants. That's the first thing you flip to. Make sure that your liquidity is not too tight. Make sure that the leverage ratio allows you the flexibility to maneuver. Make sure they're not locking you in for an extended period of time, and make sure your prepayments are within bounds, and they're not coming with these excessive costs to cut. And for the second one, I would say explore revenue-based financing, explore alternative lenders, explore more flexible capital solutions. Will it cost you a bit more? It might not, but it might. But it will allow you the ability to be flexible, to maneuver. And if something comes up in your business that you need to pivot and change, they can be there for you and they can be responsive to that, whereas a traditional lender may not do that.
Yeah, I agree. I think the overall biggest warning is around ambiguous language that could allow a lender to take control of your business in a way that you would not ever look at as something that is positive, or you might not think is likely, but the language could state that it could happen. And I think that's where you really want to be a bit into Ayas's point of whether it's investing in a lawyer or just does a more simple structure make sense. Really need to be eyes wide open around language that can ever kind of put your business in jeopardy.
Thank you, guys. So another question we have here from the audience: are there any trends from your portfolio that you can share on how businesses have responded to and are adapting to the downturn?
Yeah, so I think we actually did a pretty deep analysis, of our portfolio, and our portfolio, we have thousands of companies, primarily in SaaS, that both that have taken out financing and maybe still have financing with us, some that haven't, and that we maybe just provide insights to. So we've had a really nice kind of treasure chest of data that we're always looking at to understand how companies are performing through this cycle. One thing that I thought was pretty interesting is that there was a continuation of companies with the right metrics, still pushing on the on the pedal in terms of growing. So I think whether it's because they've planned out their capital really well, and they've already have those kind of solid margins that you love to see in SaaS businesses, it gave them really the ability to invest over time into the right channels and to keep investing there. And so that, I think, was something that was a bit of a surprise. Whereas we saw some of the expected trends naturally in the portfolio of a lot of companies pulling back on spend, particularly larger, bulkier areas that may be nice to haves. But yeah, that continued growth was something that definitely surprised me.
Brilliant, thank you. And a next question that we have from the audience here is, I need to raise this year, but I'm at risk of a down round. What are the risks that I should be aware of? Is it ever a viable option, or should I avoid it at all costs?
Yeah, I think, look, there's a reality of where the market is today. And I think we all need to operate within that reality. We look at, the public markets as an indicator of where multiples were, just a year or so ago versus where they are now. That applies across, all investment classes, right? In terms of private markets as well. And so I think, depending what a company's valuation was previously, a down run certainly might be something that happens. And I don't think it's necessarily always a terrible thing, right? It's still investing in the future growth of the business to create long-term value for, founders, employees, et cetera, and the investors as well. I think one thing to be wary of is there's been a large emergence of quite a bit of structuring in terms of equity rounds lately that kind of bring a degree of complexity to that raise process that maybe wasn't there earlier, especially for the kind of earlier rounds. Sometimes you used to see that structuring, whether it's, the different degrees of liquidation preferences and pref returns around that, that might happen in later stage startups. Now that's kind of creeping into the earlier stages and just almost like what we were talking about earlier of making sure you have a really strong grip on all the terms, good legal representation, being wary of what that structuring really means to your business, what ultimately that could entail in terms of, the end number, the end percentage dilution that you can take.
Thank you so much for your answers there, Ice and Jonah. And I think that is all the time that we have for questions today. So again, thank you so much, Jonah and Ice, for joining me in this discussion. And also thank you to the audience for joining us today and taking the time. You'll receive a recording of today's webinar in your email tomorrow. So please do look out for that. And if you have any kind of remaining questions about the discussion today, please feel free to send them to marketing@capchase.com. We'll make sure to get an answer to you in the coming days. And if you'd like to find out a bit more about revenue-based financing for SaaS, or you're interested in more webinars, events, and resources from Capchase, please feel free to follow us on LinkedIn, Twitter, or visit www.capchase.com. Thank you everyone so much for your time and have a great day.